Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is an earnings conversation. We're in conversation with the management of Aarti Industries. Joining me now is Rajendra Gogri, who is the chairman and managing director of the company. Thank you so much, Mr. Gogri, for taking the time. As I look at your performance for the fourth quarter and indeed for the full year, I'm looking at specifically the revenue number, and that suggests that there is some pressure on the demand front. Could you help us understand which segments and which geographies you're seeing this kind of pressure, and what are the contributing factors to that revenue number in the fourth quarter?
Yeah, overall, dye stuff, textile dyes was down for last 2-3 quarters, and but I think in Q1 of FY24 now it seems to be no recovery, so that had continued. But some other discretionary spend on auto and also had started showing some slowdown, both global and domestic market, and that had some impact on Q4.
Okay, so as I understand it, sir, discretionary is about 50% of your revenue mix right now, and that is essentially the place where there is a demand slowdown. Inventories are higher at the customer end, from what I see. Is that likely to continue for a little longer in the current financial year as well?
Yeah, overall, what we see that progressively quarter on quarter things should improve, like on a specific product or sector wise. Like dye stuff, we already see the demand recovery coming in from Q1 here. And similarly, over over Q1 to Q3, I think things should normalize. That is what is the kind of indication which we are getting from customers on volumes.
Okay, so then volume picture for the full year, you've guided for 25% in FY24. Is there any risk to that guidance, or are you fairly confident that 25% is achievable?
Yeah, here, because we are adding certain capacities and we'll be picking up some market share also. And as mentioned yesterday also, in that part of this volume will also go to our non-regular market also. So that's how we are looking at around 25% market share.
So, okay, so you've mentioned that you're going to target certain non-regular markets, and I think this is also strategic from the point of view that certain developed markets are showing that slowdown in demand.
Yep.
But that is having an impact, Mr. Gogri, on the EBITDA, right? In the quarter gone by as well, there's a bit of a miss on the guidance, or on the full year as well, there is a bit of a miss on the guidance because of the push towards non-regular markets. Is that correct? Is my assumption correct?
Correct. Yeah, that is the reason. And same way, because that's why our EBITDA guidance for next year is also, even the volume will be around 25%, but EBITDA growth we are looking at around 15%. So that's the difference is coming because of this non-traditional market sales.
Could you take us through which markets you'll be targeting? Will this be China, for example, or and I understand that you have exposure to China, you have exposure to Japan, 6% and 3% or thereabouts of your total revenue mix. What are these non-regular markets that you're targeting?
Generally, it will be China and sometime in Europe and also. That is possible. Yeah.
Okay. So, as I understand it, FY25, the expectation or the projection or the aim for you is to have an EBITDA of 1,700 crores. If the growth in FY24 is going to be about 15%, will it be that much more challenging for you to achieve that mark in FY25? Or do you see yourself achieving that? And what factors would lead to that achievement of 1,700 crores EBITDA in FY25?
Yeah, major thing will be all this current slowdown which we are seeing globally in discretionary spend. We expect that most of the cycle should be over in FY24, and FY25 should reach to a normal demand cycle on discretionary. And FY25 will have a new volumes coming up on projects which are going to be commissioned in Q4 FY24. And first half FY25, so that will be an additional volumes coming from those projects. So that's how we see that coming back of regular market and the additional volumes coming from the expansions.
Mr. Gogri, you're talking about chlorotoluene, right? And this is a strategic shift from your point of view. Could you explain to us how this new chemical or chlorotoluene will change the picture for you on the revenue side?
Actually, chlorotoluene and all that construction will start in this year, FY24, and all the benefit of chlorotoluene and downstream will start from FY26 onwards.
Okay. So this is not, so what you're saying, the new chemicals that, or the new capacity that you're adding is not chlorotoluene. It's, could you tell us where this new capacity is going to be directed?
FY25, our capacity is coming from that our ethylation plant, which we are expanding.
Okay.
To 3 times. Then back end nitrotoluene we are expanding. And our sulfuric acid plant will get expanded by about 22%. So these were our from our traditional product lines, expansions are happening in these 2, which are coming in on stream in FY25. Whereas chlorotoluene and all full range commissioning will happen more in entire volume will come in FY26 onwards.
Okay. So my understanding is that capacity expansion and the capex for FY24-25 is going to be something around 3,000 crore, which is, I think, going to be split evenly over the course of this financial year and next, right? So 1,500 crores this financial year. There is also the understanding that I have, which is that the free cash flows are not likely going to be enough to fund that. Will that require you to raise debt, and how much do you anticipate you will have to raise?
Yeah, this will be partly funded by internal accruals and partly debt. So there will be definitely will be taking a debt for this expansion.
But could you give us an understanding as to how much debt you will have to raise, and how will this change the debt to equity ratio for the company in FY24?
Yeah, FY20 currently we are around 0.57 or something. So that will move towards 0.775. So we should be in that range of debt equity.
Fantastic. Okay, just to give us a final take on the EBITDA number. So 15% in the current financial year. The next financial year, FY25, is going to be significantly more than that. Is there a negative that you want to prepare for? Or are you absolutely, I'm asking this question again, Mr. Gogri, and we'll talk, I'm sure, over the course of the year. But there seems to be a little bit of concern on the street about the targets that you've set for FY25 in particular. Is that too optimistic, or are you absolutely confident that this is going to take place?
This is mainly dependent on this slowdown coming back to the normal, whatever our customers have been buying and guiding for last few years. Those similar trend continues and this slowdown in demand goes off. I think we should be able to reach this 1,700 crores. It is more on all this discretionary slowdown, which we definitely hope that by FY24 all that goes off, and FY25 is more of a normal buying, all the inventory correction and everything gets over by that time.
I'm also, and this is my last question, seemingly on a sequential basis, if I look at the cost side, energy costs have come down, but raw material costs seem to have risen. Is that also going to put pressure on margins? I think, if I'm not mistaken, you have spoken about passing that on in price increases. Have you already done that, or do you anticipate that in the current quarter and the coming quarters, there will be more price increases across the range?
No, in general, the core raw material are all passed through. So that is generally is not an issue, whether it's going up and down. So that is a normal pass through.
What is your base case assumption for cost? Do you anticipate that is going to ease in FY24?
No, I couldn't get you.
What is your base case assumption for cost, for raw material cost in the current financial year? Do you anticipate that easing off further?
As such, we even don't worry about benzene prices. So what is the price? Because that is going to go through pass through.
Okay.
In that sense.
Yeah. Fair enough. Again, Mr. Gogri, thank you so much for taking the time. Pleasure speaking with you. Wish you all the best for the new financial year.
Thank you.
Viewers, do stay tuned. Lots more coming up in just a bit.